many of the same themes, but they seem a little different this time. So what I'd like to do is check in on the markets, see where we are for the first half of 2021, review some of these market forces that are driving the markets that have our attention, and then look at the foundation portfolios and see what it all means to the portfolios. So let's check in on the markets. The markets have been very strong across the board, broad participation in the stock markets. The S&P 500 year to date leads the way of the major market indexes, up 17.5%. But even the Dows, the largest and smaller capitalized stocks that are included in the Russell 2000 have had participation in this market. We're off to a great start. The only exception really has been the Shanghai Composite Index this year. It's down from its highs in February of 2021. And you may have seen in the press recently concerns about the Chinese government becoming involved in their public companies and putting restrictions on companies. And that index reflects some of those concerns. But other than that exception, really broad-based participation in a very strong market year to date 2021. And it's been across all sectors. Here we're showing sector performance of the S&P 500. And you can see across most every sector, very positive performance year to date. And I think that one of the things that we can be reminded of as we look at this chart is look at energy. Energy is the leading sector in terms of year-to-date return at over 28% year-to-date. But if you'll remember, last year, energy was the worst performing sector. So it just goes to reminder that it's important to be diversified, to have exposure in all different sectors, because the worst one year can very easily turn out to be the best performing the next year. Interest rates, I think that, the consensus has been that interest rates would tail up as we came out of this pandemic with with an uptick in economic activity. And actually, we've seen the opposite. Here we're showing the 10-year Treasury yield over the last 6 months. And clearly, the Treasury market has been more concerned about an economic reversal with this new strain or variant of COVID and what it might mean to both domestic and global economies, and seeking safe harbor. The bond market is much more concerned about that than it is right now about inflation or Fed policy or anything else. So I think that it's interesting to see in a world where very often on press, and print, we're reading about the dangers of inflation and rising interest rates. Actually, the 10-year Treasury yields have fallen over the last 6 months or the last 4 months. So as we take survey and inventory of forces that are driving the market, I'd like to just highlight 4 that I think are really important and deserve our attention. First and foremost is the vaccine, both its application and its effectiveness, not only here at home, but globally, and what it means to corporate earnings and global productivity. The second is corporate earnings and stock valuations. Third, Fed policy, inflation, and interest rates. And I think the 4th market force to watch is the stimulus and infrastructure programs that are making their way through the process. So first of all, vaccines. It's not only the vaccine but it's also its application and its effectiveness. Today, 50% of all Americans have had 2 doses of the vaccine. More hopefully though, 70% of all adults, so those over 18 years or older, have had 1 shot or 1 application of the vaccine. So we're getting closer to that magic number for herd immunity, but we're not there yet. And this Delta variant seems, particularly troublesome, and I think deserves real respect in terms of just what it might mean for our economic recovery. We're already seeing some places like Los Angeles County revert back to some of the measures that were first implemented when we saw COVID 18 months ago. So we're seeing upticks in trends, infections, and the effects of that are troubling. We also have a concern, all of us, around what this variant means and what its effects will be in terms of allowing workers to go back to work, allowing kids to go back to school, allowing us to get back to normal. So this is a continuing story and a continuing force in the market to watch. The other is corporate earnings. And what we're seeing now is that the price to earnings ratio on the S&P 500 has actually fallen a bit from where we checked in on it last. And that's been driven really by very strong corporate earnings. And corporate earnings continue to, predictions continue to be increased on the street. Today, the street consensus is that for every share of the S&P 500, there will be about $191 of earnings. That divided by a current price of 4,419 on the S&P gives us a price to earnings ratio of about 23.1. It's still elevated historically, still lower than it was in 2000 and at the 2007 at the financial crisis. But over the last 8 or 9 years, it is higher than the trend, but it's a story to still follow in terms of whether or not corporate earnings will rise to the occasion and bring valuations closer to a norm. So this is a story that continues to deserve our attention. Fed policy, inflation, and interest rates. Again, we heard from Chairman Powell and the Fed yesterday. There's a real steady hand, a sense of patience at the Fed, and no sense of urgency to rising interest rates. One big question is what happens with inflation? We've seen spikes in inflation, particularly around commodities, but the question is, are they anomalies, transitory, or are they more systematic? And lumber prices, for example, can be pointed to as a spike that normalized. And so the question is really, where are we in terms of inflation as we work through the reopening and kind of the kinks and all of the supply chains? Interest rates, at least on the 10-year treasuries, have fallen over the last 4 months, but it's something that we'll continue to watch. And then finally, I think one of the big forces for the market will be the stimulus and infrastructure plan and how it affects housing, employment, and economic growth. In terms of housing, as you know, we've had this program in place, the Emergency Rental Assistance Program, as well as the Mortgage Relief Program, both of which are being phased out. And the question is really, what does that mean to housing? And what does it mean in terms of displacement of millions of people potentially? So it's worth watching, especially in a very hot housing market, what the end of these subsidies will mean. In terms of employment, it's hard to get back to full productivity without full employment. And employment is just stubbornly stuck at about 6% right now. So a big question is what does it take to get people back to work? Whether that's having kids in school so that both parents can get to work, whether it means companies opening up again for on-site work. But also, post-COVID, employers or employees have become more discerning and have not had the same, with stimulus in their pocket. It's been they've been more discerning and less likely to go back to the same employment pre-pandemic and pre-stimulus. So how does all that work out? What does it mean for the employment and productivity numbers? And then, of course, economic growth. And the stimulus was meant to spur economic growth. We've seen that, was just announced today that GDP grew 6.5% in the second quarter. But how long does that last? Our hope is that it lasts for several quarters, if not longer. Is it here to stay, or is it more transitory? But then also, the question is the best yet to come? We have a little bit more stimulus in the pipe, in the works with the infrastructure bill that is a bipartisan bill, apparently, that we should see passed in the coming days. So how does stimulus and infrastructure, affect us in terms of housing, employment, economic growth? Again, worth our attention. So with all of this going on, it's hard to have a lot of absolute certainty in the market. But one of the things that we can have confidence in is a long-term strategy of diversification, of aligning portfolios with risks and time horizons, and to have a broad-based, disciplined approach to portfolio construction, which is what the United Methodist Foundation Northern Illinois Conference offers to its churches and to its clients. And the portfolios that have been offered by the foundation continue to do very well. They continue to do exactly what they're designed to do. What the foundation is trying to do is to deliver portfolios that have an index-based return, that have broad exposure with low fees, but do so and create portfolios that are compliant with really the Wesleyan principles of doing no harm and doing as much good as possible. And the portfolios are built to try to mimic an index-based return plus or minus 1%, but doing it without objectionable securities and trying to allocate resources to have a positive impact in the world.